With us, Atul Shinghal, the founder and CEO at Scripbox, joining in the show. Atul, hi, morning. Good to have you on the show. You know, the share of millennials in the mutual fund industry, and share with us what really is the pattern that you're witnessing. Because, you know, time and again, our conversations with either a Zero Dha or the Bombay Stock Exchange seem to be indicating that trading activity has actually increased in the months of lockdown. Has that been the same experience when it comes to mutual funds too?
Hi, good morning. No, so yeah, it is similar in the extent that we've seen people continue their SIPs, which is very heartening. There's been a little bit more activity in terms of customers who were nervous and were trying to time the market and come into it. But overall, in the mutual industry, at least from our perspective at Scriptbox, it's been a pretty steady ship. While in early March or in late March, we did see some increase in withdrawals, but otherwise after that, customers have sort of continued to with their SIPs, one-time investments have held steady, and hearteningly, the withdrawals have substantially come down. So millennials have, this has been across categories. I wouldn't say this is specific to any age group, at least in our portfolio. Let me tell you a little bit more about, how we see the millennials, because though it's a broad category between 25 and 40, we see a very different behavior between people about 25 and 30 who are just getting started in investing, 30 to 35 who sort of got used to the investment patterns, and 35 to 40 where people have a lot more responsibility, are probably married, have had children. So people are actually investing for very, very different needs. And depending on why you're investing, your behavior changes with time. People who are just getting started are obviously looking to sort of just see, to dip their toes, whereas the people who are between 35 and 40 have much longer term plans, investing for their children's education, sort of thinking about their retirement. So depending on your own life stage and your wealth stage, people take different actions in the markets. And that's been our experience, not only during the lockdown and during the recent past, but historically over the last 7-8 years that we've been helping customers invest.
What's been the reaction from customers on the debt side? You know, when it comes to investing, we always think it's equities and it is SIPs. We start at equities and then we stop at SIPs. But debt is a large part. And when you see an episode like Franklin, which is bad PR for Franklin, bad PR for the industry, and a lot of disruption for debt investors who think that debt is safe. What's been the experience at Scriptbox?
Oh, it's actually been very, very good. So unlike most other players, when we do recommend funds, so just to talk a little bit about Scriptbox, our solutions are curated. So we're not a transaction platform which allows you to buy whatever you like. We actually give you curated solutions depending on your needs. So we got something called long-term wealth, which is for people looking for long-term needs, where we give between 4 and 8 funds across categories, different sub-asset classes. Similarly, in short-term money, as we call it, which is our equivalent of debt, we've got 3 funds we recommend. And for emergency money, we recommend a couple of liquid funds. And historically, when we have selected these funds using math and science, we have sort of preferred funds which are very low risk. So actually, none of our portfolios had any Franklin Templeton, especially those 6 funds which suffered. We didn't have them. So actually, our customers were very pleased. We ourselves were very assured that we had done the right thing. So our customer investments in debt funds have actually gone up over the last 2 months. So apart from a little bit of, we obviously had to spend a lot of time assuring customers, and communication matters in this thing. It's across business. But we've not, thankfully, seen impact of the Franklin specifically. Yes, lots more questions. Yes, lots more curiosity, need for assurance. But overall, we've, at least at Scriptbox, actually been through this very well. I hope I answered your question.
How much, also if we're taking a look at digital
Could you repeat
If we look
that?
at digital investing platforms gaining market share of the last few years vis-a-vis traditional investing, is there a cost advantage here as well? You know, that digital platforms are cheaper. What are some of the other advantages of using digital platforms, and which are perhaps the segments or regions which are benefiting most from having this option?
So that's a lot of questions, and I'll answer the questions in three different parts. One is about the cost. Are they cheaper? Obviously digital, and because you've got far more cost-effective solutions, which are digital-led, you're able to pass on those cost advantages. But I think it's actually beyond cost. It's actually the convenience, it's the access which you're able to provide to customers, which is the real benefit in terms of pure cost. The customer's time, the customer's peace of mind, the customer's ability to see what they have all the time is the real cost or the value you're delivering, apart from purely a cost play. And this actually plays out for our customers because we're able to offer them more solutions at the same price. In terms of the value that online platforms are able to add, I think it's a full stack wealth management solution, and you can use technology and digital solutions to do that, whether it's financial planning, whether it is goal setting, and actually you can keep changing your goals because you've got all of these tools, whether it's asset allocation using sort of optimized portfolio theory, whether it's fund selection like we do at Scripbox. We actually look at, say, 800 equity funds and recommend 8 through various filters. It's the ongoing monitoring, more importantly, which I think matters a lot. Apart from the whole convenience of transaction, which I think is just the table stakes to play in the space, apart from which makes it easier for customers to invest through a single click rather than signing any forms. So that's just the easy part. But actually, the ability to monitor their portfolio all the time, regularly course correct as required, asset allocation sort of management as you go towards your goal is really important. And actually, this basket of conveniences and transparency which you're able to bring to the market is really the benefits which online investing brings. Obviously, you're able to use science much more and give a very standardized and customized to the extent that risk management, asset allocation is very customized to the personal needs. But you're able to provide a very standard level of service to all customers. So personal biases don't creep in at all. You're able to train your people better. In terms of segments, I think we've seen that from the early savers, which start with early adoption, to very mature investors. I mean, some of our investors have more than a couple of crores invested through us because they're able to find the convenience, there are experts behind what we offer, so they're able to trust us. So apart from these segments, what's important is our reach. Right? We have customers, we've got tens of thousands of families who invest through the Scripbox platform, and they're across 1,250 cities in the country. Now, that's not easily achievable for somebody with a bricks and mortar model only. That said, this is a trust business. Apart from obviously a great online experience, we're also able to provide a human touch. So we are always accessible. My own calendar is open to anybody who wants to talk to us, which was very, very important during the whole lockdown and the whole assurance when the markets corrected so heavily. So we've got relationship managers available on the phone, available through video conferences. So it's the whole solution which we're able to offer. So traditionally, online is seen as only a transacting platform. That's actually not what is an offer. What's an offer is a full stack wealth management solution for the customer to manage their entire investment needs. Like we always say, our vision is to help 1 million families retire happily with financial freedom. And I think we can do it much better by doing it online.
Okay, just as we wind up, Atul, we're running out of time, but your current AUM is roughly about 1,000 crores. Talk to us about the growth opportunity. We've been, of course, listening to some of the advantages as you've pointed out. What's the opportunity or the outlook then going ahead?
So actually, we're closer to 1,500 crores. So we've been growing steadily. So probably the number is slightly dated. We continue to expect to double every so often. This is driven by, I think, 3 pillars. One is more customers trusting us, both as they come on through the early savers and word of mouth. This is a trust business. Our As I said, tens of thousands of families telling their friends and family to come on because they trust the relationship. So as we get more customers, we'll grow. We're offering more solutions. As our customers have grown with us, as I said, we started 8 years ago, built the category actually. Nobody else was offering online wealth management before we came along. And as our customers have grown with us, their needs have grown. So we are able to offer more solutions and get a larger share of wallet from them. And that's our second pillar of growth. The biggest pillar of growth in any asset management business like ours is actually the snowball effect. So a customer starts with 10,000 in month one, invests say 1.2 lakhs over the first year. That grows to 1.4. Next year, they increase their commitment, go to 1.6. Next year, go to 2. So over a 10-year period, you're suddenly looking at a person with 25 lakhs of portfolio. And hence, those are our pillars of growth. We expect to continue to grow very rapidly as the market grows. And as you would know, India is a hugely underpenetrated market. Retail, fixed deposits continue to be a large player, and we expect people to move that money to inflation-beating returns increasingly through people like us.
Fantastic. Thanks for joining us this morning, Atul. Good speaking with you.